This is Michael Nix, your Chief Investment Officer for Verity Investment Partners. I'm excited to continue our periodic video series providing insights on market and economic conditions that are impacting today's investors. In vain, without question, one of the most significant drivers, both I think from a positive and negative sentiment, depending on the segment of the market you're in, has been the influence of artificial intelligence.
Yeah.
And AI is really becoming the defining investment theme of the decade. So, from your perspective as strategist, how do you distinguish between really transformational technology and speculative enthusiasm? And at what point does one control the other in a sense?
Well, I think that there's always a bit of both in any kind of major transformational technology.
Right.
And I very much think that AI is that, but that doesn't mean you don't get to a level of froth and hype where you have to reset the clock a little bit. What I do think is maybe an important differentiator relative to the late 1990s dot-com bubble was in that environment, it was a build it and they will come backdrop. So all the telecom infrastructure build out was driven
Right.
by forward expectations for demand, not current period demand. That is not the case this time. We actually still have more demand than there is supply. I think what we're starting to come up against is concerns about the return on investment, concerns about the ability to continue to spend, given at times supply chain problems and shortages, not to mention the inflationary impact of this AI build out and the fact that enterprises are now stepping back and making assessments as to whether the build out cost as a user of AI is worth it. At what point are we able to actually quantify the productivity statistics? So I'm wildly optimistic. I think this is
Yeah.
an AI boom, but I think there may be, if there is a bubble, and it ties back to what we first talked about, Michael, which is it may just be that the expectations bar gets set a little bit too high, or there isn't a grasping of the notion of demand destruction that happens when prices go so high and or availability starts to get constrained. The last thing I'd say is, increasing concern about the move toward debt financing, given that a lot of the spend exceeds cash flows. That's something to be mindful of. So far, you're not seeing any kind of blowout in credit spreads, but it's something to keep an eye on,
Right.
given the burgeoning concerns about whether that is the beginning of some sort of accident waiting to happen.